Hello, everyone. I'm Ted Oakley. I'm managing partner here at Oxbow, and it's my pleasure to have Morgan Housel here today, author of The Psychology of Money. And Morgan's book has sold, I think, Morgan, 250,000 copies, I believe you told me. And it's one of the better books that's been out, I think, in the last few years. And I think in my career, I've read most of them and seen most of them. Morgan is a partner at the Collaborative Fund, and a really interesting guy. And I have to say, for his age and time in the business, he's a very astute guy, and I'm impressed with Morgan. But with that said, Morgan, welcome to the Oxbow interview today.
Well, thanks very much for having me, Ted. It's an honor to get to do this. I'm glad we can still do these even if we can't see each other in person. So thank you.
You bet. I'm going to get right into it on the book, and I would encourage all of you out there to get a copy of this. I've read this book twice, maybe 3 times, and it's an excellent book about what goes on in the minds of people with money. And since I've done this a long time, I can really relate to a lot of things that came out. But Morgan, let's talk about, in your book, you talk about getting wealthy versus staying wealthy, about frugality and paranoia. If you had to, I think you summarized it with the term survival. You might comment on that.
Well, here's how I think it. The difference between getting rich and staying rich are 2 separate skills, and you have to nurture them on their own. And those skills can often contradict each other, which is why it confuses people. The way I've often framed it as people should save like a pessimist and invest like an optimist. What I mean by that is this. You want to invest like an optimist. Getting rich requires being an optimist, swinging for the fences, taking a risk, being optimistic about people's ability to solve problems, for companies to become more productive, for those profits to accrue to shareholders. That requires optimism to get rich. Staying rich requires almost the polar opposite. You need a level of pessimism and paranoia, and an acknowledgement that a lot of what economic history is a constant chain of setbacks and disappointments, recessions, bear markets, pandemics. You need to be able to survive financially and endure so that you can stick around long enough as an investor to enjoy the long run and to compound your assets that are invested in the long run. A lot of people view optimism and pessimism as black and white. You're either one or the other. I think they need to coexist with themselves, and you need to have this cognitive dissonance of part of your brain is always an optimist and part is always a pessimist, and they work with each other to keep you in the game for long enough for your assets to compound.
And it's interesting, I will tell you, we worked for 35 years with business owners after sale. That's one of our primary groups we work with nationwide. And it's interesting because what you talk about right there about people that make the money, it's one thing to make it and it's another thing to keep it, which is what this is relating to in your book.
And what's interesting is, they are totally separate skills. We should not expect people who are very good at getting rich to also be good at staying rich. They're different skills. And I think, but they're often viewed as one skill. Rich is just one thing. I think we really have to separate the two and realize that they need different skills and different treatments.
And with the business owner's ego, since they did get rich, I mean, they made a lot of money. They have the tendency to think that, since I could do that, then I could do this. And as you say in the book, they're 2 different skills. So let me ask you this. You may use a term, and we've used this similar term, not exactly, but in the term we call it financially unbreakable. Could you comment on that?
So here's how I think about my own personal finances. For most people, if you saw my application, most people would probably say that for someone my age, income, net worth, I'm too conservative. A higher percentage of cash and bonds than I would need. Not dramatically conservative, but a little bit more conservative. And I actually don't view it that way, because what I want to do, the reason I have a relative share in cash and bonds is because the number one thing I want to do with my finances is be unbreakable. I want to be able to survive and endure every recession, job loss, medical emergency, divorce, heaven forbid, but these things that are realistic parts of all of our lives eventually. I want to be able to survive them so that the assets that I do have invested in stocks will never be touched. Because if I never touch those stocks that I do have invested, I never need that capital to pay my bills, so to speak. I'm going to be able to let those assets compound for 20, 30, 40 years, and that's where the fortunes are made. Compounding is not something that takes place over 5 or 10 or 20 years. Compounding is a lifetime endeavor. Charlie Munger has this great quote that I love where he says, the first rule of compounding is to never interrupt it unnecessarily. That's why I want to be unbreakable. I want to make sure that I never interrupt the compounding in the assets that I have invested for the long run. So I think like focusing on endurance and longevity and survival is the number one investing skill that anyone can think about. Warren Buffett phrases it where he says, to do well in investing, you first have to survive. And that's really what it comes down to. It's the same for business as it is for investors. There's this quote that in business, the only forgivable sin is running out of cash. All the other problems you can fix, but running out of cash, you're done. You're out of the game, you're done. And it's the same in investing. We really have to focus on endurance more than anything. And also, Ted, I would say we've learned in the last year the number of risks that are in the world that we're not thinking about, that we can't foresee, that may have never crossed our minds. The fact that there would be a global pandemic that would shut the global economy down for now going on 12, maybe 18 months. Most of us never considered that as a risk, but it happened. And I think that should give us a level of humility over the number of risks that might face us in the future that we're not thinking about right now. And that, again, just pushes us more towards having a survival attitude and a mindset of room for error in our finances.
You know, Charlie, who is, I think, 97, just had his annual meeting for one of the other companies, the court reporting company, I believe. And it was one of the things that he commented on in there was the fact that he really got into all, and that's just the last few days, but commented on a lot of the things that go on about being, somewhat unbreakable, as you would call it, and a lot of things that are going on. Let me ask you this, and you talk about giving in the book about giving yourself some room for error, and something that we've always believed in at Oxbow is that leverage is the killer. You get too leveraged and you can't do anything, but you might comment on the leverage side.
I think doing well, if you think about having endurance in finance, really what that is being able to survive the widest range of outcomes possible, so that the gap between what I need to have happen and what might happen is the widest that it can be. If you have that, then you're going to be able to endure the ups and downs so that you can compound over time. What leverage does is it pulls that away. Leverage reduces the number of outcomes. It lowers the number of circumstances that you will be able to survive. And the more leverage you have, the more you rely on one scenario playing out. And if anything but that scenario plays out, you're going to be in trouble. That's what leverage does to you. Of course, it can provide upside, but it narrows the range of outcomes that you can endure. And so to me, it's not only about getting rid of leverage, by and large. Of course, there's good debt. I'm not a debt zealot, so to speak. But having room for error is just this idea that I have a view in my head of how my life and career will play out and how the global economy will play out. I have a view of what I think is going to happen over the next 20 years. But I know with certainty that view is wrong. And this can be disheartening for people to hear that, we all have a view of what we think is going to happen in the world, and it's wrong. Every single one of us, the view is wrong. No one was able to predict with any sort of precision Pearl Harbor, September the 11th, COVID-19. That's how history plays out. It's a series of surprises that takes people off guard. And the takeaway from that as investors is we need to be able to endure the widest range of outcomes possible. That's what room for error is. And that to me, is room for error is probably the most underappreciated and important skill in asset allocation and asset management. It's being able to having the widest gap between what you need to have happen and what might happen in the world. The other way that I phrased it as the most important part of a plan, like planning is important, but the most important part of a plan is planning on your plan, not going according to plan. That's the single most important part of any financial strategy.
And we work and always have with business owners that sell companies. That's what we've done for 35 years all over the U.S. And one of the things we've found about them is that we really impress upon them that you need to know, you're talking about your assets being put in different places. And we try to emphasize on those people like that. They've got plenty of money. Try not to get in a situation to where you get too leveraged, things don't work. And I think, and the other side you have to be is if you're used to running your own business and you've got a piece in there called nothing's free, and you might comment on that because what you say is that you're in the situation where, hey, if you're going to invest in the market side, you're going to have to be able to go through volatility.
Yeah, it's just It's just this idea that everything that's worthwhile in life has a cost of admission, has a fee that you have to pay. A lot of those fees are not price tags. They're not priced in dollars, so to speak, but there is a fee. The price to pay for good returns in the stock market is pretty obvious. This is not a groundbreaking idea that I have, but it's putting up with and enduring volatility. Now, what's important about this is that a lot of investors do not view volatility as a fee, as the cost of admission. They view it as something different. They view it as a fine. The difference between a fee and a fine is subtle, but it's very important. A fine means you did something wrong. Shame on you. You made a mistake. Here's your fine. Don't do that ever again. A fee is a cost of admission for getting something that you want on the other side. You go to Disneyland. It's $100 to get through the door. And congratulations, you're not in trouble. It's $100. Now go enjoy the theme park. That's what a fee is. And I think viewing volatility as a fee instead of a fine is very important, because a lot of investors will view, if their stock portfolio went down 10 or 20%, let's say, will view it as an indication that they made a mistake. They screwed up. Their financial advisor made a mistake. This is wrong. I'm not supposed to lose a fifth of my money. This is a fee, this is a fine for doing something wrong. That's how a lot of investors view it. And I just think it's much better, a much more productive and accurate way to view volatility as a fee, the cost of admission for getting superior returns than you can get in cash or bonds. You can, of course, earn much higher returns in the stock market than in cash or bonds, but you have to put something forth to that. There is a cost of admission for that. And the cost of admission is volatility. You have to be able to put up with, historically, every 4 to 7 years, the stock market has lost between 20 and 30% of its value at least once. That's a historical average. I would expect that to be the case going forward. Now, the important thing is that at every one of those 20 or 30% declines, you have investors all over the world who say, this can't be right. Something feels wrong. This feels broken. And so I want out, without realizing that it's actually just the cost of admission that you have to be willing to pay to do well.
Well, and also, of course, I've probably been around longer than most people, but sometimes they're 35 or 50%. And
that's right.
You got to have your head on straight. It's interesting, too, from 1966 to about 1983, the markets went zero, went nowhere. And the same way from basically, 2000 to 12, if you wanted to go up and down. And I think that's where I find people are not willing to stay the course on that sort of thing. And so if you're going to be in it, you're going to have an idea of where it is. So that's a great answer. It's a good piece of word you talk about in the book. You mentioned in the book about having a good sense of your future regret. Now, I find that with most investors, that regret is one of the worst habits they have. But you might comment on that sense of your future regret.
I think what we all need to think about as investors is, what is the point in which we cry uncle? What is the point in our portfolios in which, because they've had a period of underperformance, a period of losing money, that we say, enough, I can't take it anymore? We need to understand where that point is for all of us, and it's different for all of us. It's a very personal metric. It's going to be different for me than it is for you, than it is for anyone else. But until we know that point, a lot of people don't. If you don't know where that point is, you're going to learn about it the hard way. You're going to learn about it by crying uncle eventually in 2012, after a decade of underperformance, when you say, I can't take this anymore, get me out, stick me all into gold, stick me all into bonds, whatever it might be. So I think knowing where that point is and just realizing that it's personal, that it's different for everyone, is so incredibly important. And I think the only way that you can really learn that, where that level is, where the crying uncle point is through your personal experience. I don't think there's any way that we can forecast where that is. But what I would always recommend that people do is look at how you behaved in March of 2020 when the market lost 35%. How did you behave in 2008? How did you behave in 2001 during those bear markets? How you behave during that time is the single best indication of your future behavior. A lot of investors will try to anticipate how they might feel hypothetically during the next bear market, or assume that they've learned their lesson from the last bear market. And by and large, that's not the case. I would look at your past behavior and just embrace that that's who you are. And if you panic during those periods, and a lot of people did, not everyone, but a lot of people did, embrace that you might have a lower risk tolerance than you thought you did. And also, if you did totally fine during those periods, then congratulations, you are able to endure. Maybe you can take a little bit more risk in your portfolio. Just realizing that it's personal and you need to know where your breaking point is so important for investors.
And one of the things I've found over the years is that most people are probably more risk averse than they think they are when it gets right down to it. When you get into the foxhole and things are really bad, they get into a sense and regret comes into play. And so I always recommend to people, if you're going to lean one way or the other, rather than lean more aggressive than your actual personality, you might want to go less aggressive than your actual personality. And you talk about that, about the regret of which way, have a sense of your future regret, I think is the way you call it.
There's this great quote that I love from Nassim Taleb where he says, if you're going to panic, panic early. Like, just get it done out of the way if you're going to, which is good advice if you're going to panic. There's another point here that I think is really important, which is that if you and I are having a conversation today in February of 2021, when the world, of course, we're in the middle of COVID-19, but the markets are doing very, very well and have for the last year. And if you and I said, hypothetically, Ted, how would you feel if the stock market fell 30%? By and large, what everyone does during that question is they imagine a world where everything is the same as it is today, except for stock prices that are 30% lower. So in that situation, it's easier to say, well, I would view it as an opportunity. I would love that. I would invest more money. If everything is the same today, except stock prices are cheaper, that would be great. But that's not how the world works. The reason that the market is going to go down 30% is because there's something going on in the world that is terrifying. September the 11th, COVID-19, where we didn't know if our loved ones were going to survive this terrifying periods for everyone. That is a totally different mindset. So the reason that the market does decline is because something is going on in the world that scares people, and it might scare you too. And that is why people have a bad sense of their future regret. It's not just anticipating the market declining. It's anticipating the world breaking in a way that shakes your faith in the market being able to ever recover. That's what happens. And that's why it's just so important to look at your past behavior during the periods of uncertainty and realizing that that's how you're likely to respond in the future.
Because you talk about in your book about the boom-bust cycle, and the type of person that gets in trouble has the same personality traits that made it to the top and owned their own company or had a successful company. Those same traits blew them up on the other side when they became an investor.
The kind of person, and I'm grossly generalizing here, this is not for everyone, but the kind of person who is able to become a billionaire through their investments, let's say, is not the kind of person who at that point is going to say, okay, this is enough money, let's put it all into muni bonds. Like, generally, the kind of person who can become that successful is the kind of person who says, I'm swinging for the fences. T. Boone Pickens is probably my famous, my favorite example, the late oil tycoon, multi-billionaire who made and lost several fortunes, from multi-billions to zero, back to multi-billions to zero. That was his personality. The only thing that he could do was swing for the fences. That's all who he was, and bless him for it. It was wonderful. But I think that's why the boom bust cycle occurs, is that the way that the kind of people and the kind of behavior that caused the boom, the big risk taking, the swinging for the fences, also sets up the seeds of the next bust. And also the bust sets up this, plants the seeds for the next boom. When you view it through that sense as these things being inevitable, not just a flaw of capitalism or a flaw of the economy, but an inevitable part of it. And we're never going to get rid of that cycle. It makes dealing with those booms and busts a little bit more palatable. It's not that it's fun to go through a recession where you or people might lose their jobs, you might lose half your net worth. It's not enjoyable, but it's inevitable that those cycles occur. They're always going to occur. It's never going to end.
It's interesting. I was visiting a friend of mine invited to go with Boone to his ranch, and I asked him this question. I said, would you do it the same if you had to do it all over again? Because like you talk, he was up and down, up and down, up and down. And he said, yeah, that's my personality. He said, that's what we do in the oil and gas business. And so it's interesting because he did have that in there. And then another thing you talk about in the book along that same line is what's enough. I think people need to understand that. But I think one of the things you mentioned about is you get to the goalpost, you win the game, but they don't stop. And you might comment on that. I thought that was a really good part of your book.
Yeah, thank you. I think it's just the idea that the hardest but probably most important financial skill, personal financial skill, is getting the goalpost to stop moving. It's great to have goals. I have goals. Everyone should have goals. But once you meet those goals, the natural progression is to say, okay, I checked that box. What's the next level up? What's the next rung that I should shoot for? And that game for some people never, ever ends. Unless you are Jeff Bezos and Elon Musk, there is someone else getting richer than you are right now. And if you are always just going to keep looking up and up and up, that's a game that I think a lot of people don't necessarily want to play. Some people might like that game, but some people want to say, no, what I want out of my financial goals is a level of peace and independence in the future. Can sit back and enjoy the hard work that I've earned and built up over time. And if the goalpost never moves, I think you're never going to really sit back and enjoy what you've earned. So it's so incredibly important. It's so difficult as well. I try to think about it with my own financial goals of how much is enough. What is the net worth at which I would say, okay, I'm really going to scale back work now and spend more time with my friends and family. I have that number in my head. And if I'm lucky enough to get there, will I actually do it? I hope so, but I don't know. It's a very difficult thing to do. But I have seen, I'm sure you have seen, and everyone watching has seen, people who are very successful beyond their wildest dreams. And when they get there, all they can think about is the next level. I'll tell you just a personal story of this. There is an author who I really look up to. I will spare his name, but I really look up to as, man, I wish I could be as successful as that author. And I had a conversation with him last week. And during that conversation, all he talked about was this other author that he looks up to. And it was so jarring for me that in my mind, I want to be this guy, and all he wants to be is some other guy. Like, we're all just playing this silly game. And I think all three of us authors should step back and realize that we're fortunate to be in this position and be grateful for what we have. You can be grateful for what you have and still be ambitious. It's not to cut everything off wholesale, but I think realizing that everyone needs to have an idea of what is enough is so important, because if you don't, by and large, a lot of people will keep taking risk, will keep stretching, keep swinging for the fences until they break. Someone like Boone could break and then build back, but a lot of people, once they break, they're done.
Well, we've worked with business owners after selling companies for 35 years or more. And one of the books that I wrote was entitled 20 Million and Broke. And with a lot of business owners, they have that quality to go make money and turn it again. I think, you write about it in your book, about the same quality that got you wealthy or you became wealthy is the same quality that might make you lose all the money. And you have to be careful with that. And we've always tried to get that over to everybody. But I do think you talk in the book about committing to a strategy. Have a strategy that you can stay with through lean and great years. You might comment on that.
I think that's really what matters. I mean, it all gets back to compounding is the rocket fuel of investing. Compounding is what makes people wealthy. Whether it's a private business or the public stock market, compounding is the magic that we're going for. And compounding only works, its main fuel, its ingredient is time. How long can you compound for? If you think about it through those simple terms, then really what we need is not the best strategy this year, but the strategy that we can stick with for a long period of time. And here's what really gets people. This is the nuance here. A subpar investing strategy that you can stick with is going to build more wealth than a perfect investing strategy that you cannot stick with. That's really what gets a lot of people. And this is why, to me, my individual investments, I talk about this in the book, tend to be fairly passive. And the reason is not because I don't think people can beat the stock market or that I don't know investors and fund managers who will outperform the averages. That's not the case, because I do know those investors. The reason is that I want to make sure can stick with a strategy for the longest period of time. And to me, for my personality, that strategy is probably going to be the simplest hands-off strategy that is. That is, I think, the strategy that's going to compound the most wealth, even if it earns lower annual returns this year or next year. So I think there's a lot of nuance in there that can get lost. But for most people, and I think a lot of people like to hear this. It gives them permission that if there is a subpar investing strategy that might not be the best on paper, but you know that you're likely to stick with it because it's interesting to you, it's exciting for you, you like following it, you're not going to get bored with it, that's probably the right strategy for you. It's all about how long can you stay in the game. And people, and we've managed money for a lot of years, and one of the things I find with people is they get into comparison mode, and they need to understand themselves. That's the person they need to understand. And I find one of the things I find, and I've written quite a bit on this too, about the psychology of staying rich, is that if you don't understand yourself well enough to know where you align, then and you try to do what other people do, then I think that's where you get into problems with how you want to manage your money, because it's easy to say, because a lot of people have only come into wealth since, say, 2009 or 10. But if they go through a period like I've been through periods where
the market makes you no money really for 10 years, let's say. And then you're going to have to ask yourself, am I willing to go that course there, and stay with it for the long term? I think that's what you see, and it's interesting because you write about in the book to stay with it. And a lot of people to read that will say yes, but don't you think when you get past, let's say, I'll give you an example, 2000 to 2012, market basically up and down, went nowhere. I think people look at that and they say, I'm okay with that in the long run, but the long run ends up being 2 years or 3, and then they throw it in. And I find that you've got to really be able to mentally stick with that. You talk about
I think the idea that, there's this quote from a financial advisor who I admire named Tim Maurer, who says personal finance is more personal than it is finance. And I think investing tends to be viewed like math, like 2 + 2 = 4 for me and you and everyone. There's one right answer in math, but investing is not that. Investing is such a personal endeavor where how I behave is different from how you behave. The lens in which I see the world is a different lens from that in which you see the world. And everyone sees the world. We're all different. We come from different generations, different upbringings, different incomes, different goals. And because of that, we view risk differently. The big takeaway for that for me is that equally smart, educated, informed people can and do disagree with each other, and that's fine. We should all just pick the investing strategy that works the best for us and aim to not be coldly rational on a spreadsheet, but aim to be reasonable. I think being reasonable is the best that you can do in investing. It's just this idea that very few people make an investing decision or a finance decision on a spreadsheet. They make it at the dinner table where they're discussing it with their spouse and their family. That's where financial decisions are made. And that dinner table is much messier and more nuanced and more emotional and more hormonal than anything you can model on a spreadsheet. That's really what it comes down to. So understanding who you are and what you want, and realizing that your goal for managing money should not be to be perfectly rational. It's to give you a better life. That's what we all want out of this, just from a philosophical point of view. And if making investing decisions that aren't rational or don't seem right make you happier and keep you in the game, then that's the right thing to do. I mean, here's one example that I'll give you, Ted. There is a well-documented home bias in investing. It's documented all over the world where American investors, by and large, only own U.S. companies. German investors only own German companies. Japanese investors only own Japanese companies. It's like this all over the world. It's not rational at all to think that the best stocks that you should own are the ones that are closest to your house. That's not rational in the slightest. But it's actually a very reasonable thing to do, because if only investing in companies that you're familiar with helps you take the leap of faith to invest your long-term savings in these companies and is going to give you more confidence to stick with them for the long run because you're familiar with them, that is totally reasonable. It's not rational, but it's very reasonable. And I think we should all embrace more of that we're not trying to be rational. I'm just trying to be as reasonable as I can, given who I am, given my generation, given my upbringing, my background, my income, my family's goals. I'm just trying to build a plan that works for me.
We had a question too on that. I mean, you're a fairly young man. I wouldn't classify you as an old man, but why do you think? Because I mean, most people learn these kinds of things that you write about in your book later in life. You've obviously learned a lot of things earlier in life. What do you think that is?
Well, first, thank you, and I would say maybe it's two things. One is that I've been a financial writer for my entire career. I started in 2007, and all I've done 7 days a week since then is thought about these topics. The other thing is that part of that job, the biggest part of that job, is being a student of history. So what I get to do 7 days a week is read about financial history, investing history, and not just financial investing, but all history, political history, military history. I'm interested in how people make decisions. So I get to spend all my time learning about that and thinking about it and then writing about what I've learned. So I think just being able to do that has been really helpful for me. The other thing, let me just talk about my generation. I graduated college in 2008. And that was, of course, the peak of the Great Recession, entering the job market in the teeth of the Great Recession. So my generation started their view of the professional world began with misery, and then we had this tepid recovery, and now in the last year we're back to misery. So my generation has only known crash and then tepid recovery and then crash. Very different than if you are from a generation that had long bouts of prosperity, whether that was the 1990s, the 1980s, the 1960s. I think my generation is probably closest to, and the circumstances are so very different, I don't want to make that comparison, but closest to my grandparents' generation that survived, went through the Great Depression, and then when that was over, they instantly got thrust into World War II. That generation only knew collapse and then tepid recovery and then collapse. And it stuck with them for the rest of their life. There are all kinds of studies that tracked the greatest generation and their inability, their unwillingness to go into debt, their conservative investments. It stuck with them forever. I think my generation, by and large, is experiencing something similar. And to me, the big point of this is that a lot of what we see about the world and think about the world is just heavily shaped by the dumb luck of when we were born. And I could ask someone, I can try to study history. I can try to study the Great Depression. I can try to study World War II. And I do, and I try to learn from it. But I don't have the emotional scar tissue of someone who lived through it does. So there's a lot of what we think about the world is just so shaped by the generation, the country we were born into, the values that were instilled in us by our parents, all of which we have no control over. So I think different generations just view the world differently than others through no fault of their own.
And I think I'm not certain the chapter number, maybe it's 20, but you talk about your personal relationship with money, because we here at Oxbow, we have worked with business owners that have sold companies for many years, 35 years, and so we've seen every type of twist off that you can possibly think of that happens after they come into money, and some do well with it, and some they don't do as well with it, but you've had a good relationship with money yourself, particularly for the time you've been in the business, because I've gone through periods before where people didn't make any money for a long time, and I mean like 10 years, and then you put it to the test, so to speak. We talked about that earlier, but you seem to have been able to adjust to that very, very well, I should say.
I mean, I've had my ups and downs like everyone, and I learned the hard way like everyone. I mean, I started investing when I was 17 as a day trader, as many people begin, and I learned my lessons from that as you hope people will. So I've had my ups and downs a lot. I write about in the book, though, that I think something that was really fundamental to my money history, let's call it, is my father began his undergraduate college when he was 30 and had 3 kids. I'm the youngest of 3. And he became a medical doctor when he was 45. And my older brother was in high school. So he just had a very late start getting to us. And he was doing this. He was a student and a med resident while he had 3 kids to take care of with my mother. And that was really important because when my father was a student, we were broke. We were as poor comes. We were living off of student loans and grants. We as kids didn't know it. We thought I had a great childhood, but looking back, we were very, very poor. And then my father became a doctor, and he had the more comfortable living that comes with that. But what's interesting is that the frugality that was forced upon my parents when they were students stuck with them after they earned a decent income. So even during my teenage years when my father was a doctor, we were very frugal. And we had a decent house, but we did not spend very much money. And I looked down at the time, I looked down on my parents for it because I knew how much money they made. And I said, why don't we go buy a Mercedes? Why don't we have a vacation? Why don't we buy the nice stuff that we can? And I looked down upon them for it. So my dad was an ER doctor. And after doing that for 20 or 25 years, he decided that he had enough. It's one of the most stressful professions you can imagine. People literally dying in your hands, working night shifts and whatnot. After 25 years, he said, I'm done. I'm done with this. And the day that he decided he was done, he retired because he was so frugal during those years that he was financially independent. And I instantly realized at that moment why we didn't buy the Mercedes and the vacation house is because what my dad wanted, what was important to him, was independence. He wanted to control his time. He wanted to say as soon as he's done working, he wants to be done. He wants to be out of there. And that value of having independence stuck with me so much. So my goal, my wife's goal, we really want out of money and wealth is independence. I want autonomy. I want to control my time. I want to spend my time with who I want for as long as I want, when I want. And like that to me is the highest dividend that money pays. And it's all I really think about in terms of building wealth is how can I control my time so that I can do the work that I want, so that I can retire when I want. I can live in the city that I want to. That's really what it does for me.
I've written a number of books myself about business owners after they've sold their companies. And that's a big area where we work. And I always bring it to their attention that, hey, you have a lot of money, but you need to be happy. Whatever changes you make. And I think you've done a really good job at that. If you realize who you are, even at a younger age, who you are, what it takes to be happy, and where those boundaries are where you shouldn't go to. Either way, either too conservative or too aggressive. Would you agree with that?
Yeah, I would definitely agree with that. And to me, there is, we're all different, of course, but there is a common denominator of what makes people happy as it pertains with money. And by and large, the variable in there that we all share is we all want to control our time. We all don't like have someone else controlling our schedule. That independence is a common denominator. And I think to the extent that you can use money to do that and able to gain independence is a really valuable thing. And look, this is not a plea for people my age to, the FIRE movement, the financial independence, retire early. That's not what I'm talking about. Because almost every day when I wake up, what I want to do is go to work and do the best work that I can. But I want to do it on my own terms. I want to do the work that I want at the company that I want, living in the city that I want. And that's what I want to use wealth to do. And I think most people want that as well. I think controlling your time is something that you will never grow accustomed to, in the sense that buying nice stuff, everyone knows you tend to grow accustomed to it. It has a big splash of appeal at first, but then you get used to it. Controlling your time is, I think, something that will bring permanent happiness to your life. Or more importantly, the opposite, not controlling your time, that will bring a permanent level of misery to people's lives. So it's not necessarily that controlling your time makes you happier. It's that not controlling your time makes you miserable. And I think that's the one thing that we can do with money, that we can put a lot of effort into, knowing that 20 years from now, having independence and not being at the whim of someone else's schedule, someone else's demands, is something that's going to bring you a lot of happiness.
And I think time is important, and you have a slide which we'll show here about called "Shut Up and Wait," but it's about Warren Buffett, who is really, if basically, he's a basic investor, but he's a time person. He doesn't get shaken out at lows and doesn't get too excited at highs. Always has plenty of liquidity. Basics that we really emphasize with people as well. But I want to ask you, sort of from the standpoint of children, okay? And I think one of the toughest things today for people, and we're going to wrap up with this slide, about teaching kids about money. It's not so much in the book, but I've read a lot about what you talked about, and you have 3 quotes that are really excellent, which we'll put up here that people can see. But you talk about making children understand the scarcity of money, and that also the people that do the big allowances and the big cars and everything too early, that's not what you need for children. You might comment on that. We're going to wrap up with this question, but I think it's so important today for people to understand about children and grandchildren is, make them squirm a little bit. I don't care how much money you have.
That's right. And we're all different, of course. But when my son, he's now 5, when he was born, I wrote him a letter called "Financial Advice to My Son." It's online. And one of the things I wrote in there is I said, "I hope you're poor one day." And I said, not miserable, not suffering, but the only way that you can learn the value of $1 is to experience its scarcity. And I want you to experience that scarcity. And my wife and I think about that as well. Our children are 5 and 1, so it's a little early, but we think about that as well. Spoiling our kids, I think, I don't have any philosophical or moral judgment on that, but I really want my children to understand the value of $1. And the only way you can do that is for them to want something that costs $1 and say, no, you can't afford it, you can't have it. I think that's so incredibly important. My parents did that to me, as I talked about. My parents were so frugal, they could have spent much more, but they chose not to. And it taught me the value of $1. So incredibly important for people to see that. The other thing as it pertains to children, I would say, particularly those who have young children, is there's this example that I give that there's a lot of studies that show that your political beliefs have about a 90% correlation to your father's political beliefs. That tends to be who we learn political life from, is from our fathers, by and large. I think the same is true for money, not necessarily your father, but your parents. It's important for parents to know that even when your children are young, even if you're not talking about money, even if you're not sitting down and telling them how much you make and how you invest, they're watching you. They are watching you and they are learning from you. And therefore, we really have to be careful as parents to make sure that you are setting the example that you want to give to them. Because even if you're not explicitly telling them about it, they're picking up subtle cues in the same way that they pick up subtle cues about your political beliefs. So I try to think about that as a parent and what I want my kids to learn from me. The last thing I will say here to wrap up is that every child is different, of course. And my daughter, who's 1 year old, I have no idea what kind of person she's going to be when she's 16 and is going to start learning big lessons about money. Does she want to work for UNICEF, or does she want to be a banker at Goldman Sachs? Completely different ends that's going to have different financial consequences. So we're all so different that it's hard to pass along one size fits all money advice for anyone.
You know, I wrote another book I wrote a few years ago. It was entitled Rich Kids, Broke Kids. And one of the things that I put in there was that, you know, if you really want to help your children, make them work. Make them have to earn money. You know, don't buy the big car. Make them earn things where they, if they're going to have something that's great later on in life, they have something to look for. And I see so many times today that's happening. But I think your comments, and we'll see it on the slide here about children, is really fantastic. But I want to do this right now, where I want to thank you, number one, for visiting with us here today. And I want to show this book one more time. I would recommend anybody to read this book. I think Morgan's written a really great book. I've read this book twice, maybe almost 3 times. And I think, you know what I think about it the most, Morgan, is this is a book that has great advice about being yourself and being average. You know, not feeling like you have to go out and do something extraordinary to do well. We have a slide of, you know, Warren Buffett's net worth that you have that we'll be showing here too. And it takes a long time. He made most of his money after 50, 60 or so, I suppose.
He made 97% of his net worth after age 65.
Yeah.
Which is extraordinary to think about.
Yeah, and people don't think about that. And you know, it's something that they probably should think about. Between, you know, he and Charlie Munger have such great quotes and comments on wealth. But listen, we want to thank you for being with us today. And I would recommend anyone to, again, go out and read and buy copies and give copies away of The Psychology of Money. I know you're up to hundreds of thousands of sales now in the book, and want to congratulate you on that, and tell everyone, and I think I've probably read as many financial books as anybody, you know, because I've read for longer than most people. And I want to tell you, you've wrote a really great book here. And thanks for coming on today, Morgan, and we hope to see you again soon.
Well, Ted, that's very kind of you to say this, so thank you very much. It's an honor to get to do this, so thank you everyone for listening as well. Thank you.
All right, thanks.